Okay, good evening, everyone, and welcome to this evening session, Corporate Connect, organized by SIAS as well as supported by the SGX Group. My name is Siva or Sivanithy, as the Zoom picture will show, and I'm your host for tonight's session. Tonight's session will feature OUE REIT, which is one of the leading REITs that is listed here in Singapore. I'll speak a little bit more about OUE REIT later. But we'll kick off the session tonight with a market highlights segment, which will be conducted by Gerald Wong, the founder and CEO of Beansprout. So, Gerald, the very handsome and very capable Gerald Wong.
Thank you, Siva. I will start by giving an update on the market before we have the management of OUE REIT give us an update about the company. Okay, so for those of you who are not familiar with Beansprout, we provide you with insights on Singapore stocks, REITs, bonds, ETFs on our platform. And we have also recently been ramping up our coverage of some of the Singapore REITs to be able to share more about the outlook with investors in Singapore. Okay, the usual disclaimers that today's sharing is for information purposes only and should not be taken to be financial advice. Okay, so what I'll do is I'll give a quick update about the Singapore REITs market before we look at some of the fundamentals of the Singapore office as well as hospitality markets. If I were to look at the performance of the Singapore REITs, we have seen that it have rebounded since August in anticipation of the Federal Reserve interest rate cuts. So if I were to look at a basket of Singapore REITs, they actually rebounded close to 10% from their lows in August because of the expectation that the interest rate cut can potentially lead to lower borrowing costs, as well as a shift of funds from some of the perceived safer assets into higher yielding assets such as Singapore REITs. But more recently, over the past few weeks, we have seen some of the REITs having a bit of a pullback once again. This is because of the spike in bond yields that we have seen over the past few weeks. Okay, so basically, if you're to look at some of the key drivers of Singapore REITs, it will really be around what the US Federal Reserve decides to do with the interest rates. And what we see here is that after bringing the benchmark rate to the highest levels since 2008, effectively, we saw the first rate cut coming through in September, and the expectation is that there may be more interest rate cuts to come. So to be able to anticipate what will be the upcoming interest rate cuts, we can look at some of the core US economic data as well. What I would commonly track would be the inflation data in the US. And what we see here is that the core inflation in the US rose by 3.3% in September. This is slightly higher than market expectations and picking up slightly compared to where it was in the month of July and August. Okay. Next, we can also look at some of the key economic data. I would actually track the retail sales data in the US very closely because the US is a very big consumer market, and the strength of the retail sales will give us a good idea around what is the strength of the economy. So what we see here is that the retail sales in the month of September was once again very strong, picking up month on month by 0.4% compared to August, and that is above the market expectations. So looking at the economic data, looking at the inflation data, all of it is pointing to the fact that the economic health of the US is still fairly strong. And what some investors might be concerned about a potential recession doesn't seem to be happening. Okay, so with that, we have actually seen a bounce in the US government bond yields. Okay, with the anticipation of the US Federal Reserve interest rate cuts, we saw the US 10-year government bond yields steadily declining since May this year. From a level that was close to 5%, it reached 3.6% sometime in September, in anticipation of the US Federal Reserve interest rate cut. But since September, we have actually seen a bounce in the 10-year bond yield, and it is now back to the 4.2% level. Okay, so how can we think about the interest rate expectations going forward? If you follow the weekly market review of SIAS, we would share this chart very frequently. This would effectively tell us what investors are expecting for interest rates over the next 6 to 12 months. And what we see here is that for the upcoming Federal Reserve meeting in November, we might see another interest rate cut of 25 basis points or 0.25%. There may be another interest rate cut in December, and that will bring the benchmark rate to 4.25 to 4.5% by the end of this year. Okay, but looking at 2025, what we see here is that most investors are now expecting that we can potentially see 3 further rate cuts in 2025, which will bring then the benchmark rate to 3.5 to 3.75% by December next year. Okay, so more interest rate cuts could potentially be coming. But what we have seen based on the strong economic data is that some of these interest rate cut expectations have actually moderated. Okay, so how can we tell that the interest rate cut expectations have been what this tells us is that 1 month ago, investors were placing the highest likelihood that the interest rate would be at 3% to 3.25% by June 2025. But if I were to look at the current expectations, then what this is telling us is that the highest probability is actually that the benchmark rate will be at 3.75 to 4%. Okay, so effectively, investors have lowered their expectations of sharp interest rate cuts. And effectively, we are not expecting that there will be as many rate cuts in 2025 versus 1 month ago. Okay, so with that, we have seen a bounce in the Singapore 10-year government bond yield as well. This follows the direction of the US bond yields quite closely. So from close to 3.4% in May this year, it went down all the way to close to 2.4% sometime in September. So if you are applying for Singapore savings bond or applying for the T-bill, you have seen the fall in the bond yields. But over the past few weeks, we have seen the bounce in the 10-year Singapore government bond yield, just like what we have seen for US government bond yields. Okay, so that is the interest rate environment that we are in, and that would have an impact on Singapore REITs. What we will also look at will be the fundamentals of the REITs in terms of the sector exposure that they have. Today, I'll focus on 2 key sectors, which is office as well as hospitality. What we see for office, particularly CBD Grade A office, is that the rents have actually gone up since 2021. Okay, so that is something that we see improving over the past few quarters. But in terms of the occupancy, that has actually declined in the past quarter. And part of it is driven by an increase in supply that we have seen in the office space. Okay, so that is what we see in terms of the pipeline supply of office space in Singapore. There is actually a sizable amount of supply that is coming up in the second half of this year. But the good news is that going into 2025 to 2027, we have less office space that will be coming up in each of these years. So if we do not see a very sharp deterioration in demand, then what this means is that the demand and supply dynamic of the office space in Singapore can then become more well balanced. Okay, next we look at the hospitality market. One indicator that I would actually track would be the tourist arrivals. And what we see here is that the blue line, which is the numbers for 2024, has consistently been above the levels in 2023. So the post-COVID recovery is resuming with the relaxation of some of the measures, particularly in China. We have seen that there has been a gradual recovery in the tourist arrival numbers into Singapore. Okay, but the other key trend that we can see from this chart is that while the year-on-year increase in the earlier part of 2024 has been more significant, in recent months, the year-on-year increase has effectively moderated, and that is naturally expected given that we are now at a higher base of tourist arrivals versus where we were 1 year ago. Okay, if you were to look at how this has affected the revenue per available room for hotels in Singapore, what we see here is that the RevPAR, which is shown in the gray line here, they have effectively exceeded where they were prior to COVID, even though the occupancy rates may not be back at the pre-COVID levels as yet. Okay, so because the room rates have actually been improving, so even without the occupancy rate being back to the pre-COVID levels, we have actually seen the RevPAR now exceeding where it was prior to 2020. Okay, and last but not least, we look at the valuation of the Singapore REITs. The average dividend yield of the 41 Singapore REITs and property trusts is now at 6.3%. What this means is that compared to the 10-year Singapore government bond yield, which is at 2.6%, versus the dividend yield of the STI, which is at close to 5%, there is still a spread for what you're able to get from the dividend yield of the Singapore REITs versus the dividend yield of the STI or the 10-year Singapore government bond. Okay, so that is my update on the market. If you want to actually get more updates on the Singapore stocks or REITs, do subscribe to our Beansprout newsletter or get more updates on our website. With that, I'll hand back over to Siva, who will be able to continue on the session and introduce us to OUE REIT. Siva, over to you.
Okay, thanks, Gerald. That was a very good presentation. For me, the takeaway is that even with several interest rate cuts expected next year, interest rates will still be above 3%, right? 3.5%, which still is a far cry from where they were before COVID. So it's despite the market anticipating many cuts, it's still going to be relatively high. Okay, thank you very much for that presentation. We move on our session to the presentation by OUE REIT. Now, OUE REIT is one of the premier REITs listed here. They have 7 properties exposed to the commercial and hospitality sectors. 2 hotels, the Hilton Singapore Orchard and the Crowne Plaza Changi Airport. They have Grade A office properties, OUE Bayfront. They have interests in OUE Bayfront, One Raffles Place, OUE Downtown, and Lippo Plaza in China, in Shanghai. Also, one retail property, which is Mandarin Gallery, a high-end retail mall within 4 levels of Hilton Singapore Orchard. Now, in order to learn more about OUE REIT, I will turn our attention over to a presentation by the CEO, Mr. Han Khim Siew. Okay,
Hello, good evening, everyone.
Yes.
Siva, thank you for the wonderful presentation and introduction of OUE REIT. So for those of you who don't know us, Siva has already explained the prime core nature of our assets. The idea we have, why we have all these prime core assets, is we have a gamma strategy, which essentially means how do we actually benefit from volatility. So if you look at all the different markets, the equity market, the bond market, you look at currency, there's always a flight to quality during times of stress. So people will buy the US dollar, they buy gold. So similarly, That is what we're hoping, how we position our REIT, and we will actually benefit from that volatility. So we saw a lot of that, that benefit coming through as we were coming out of COVID back in the first quarter of 2022, where we saw our rental rates for our office buildings as they came out, we were able to push the rents up quite quickly. Similarly, for our Hilton Hotel, when we opened up in February 2022, excuse me, after we opened, just as we opened, room rates was circa 300. By April, we moved it to 400, and then we pushed it to 500 in May. So again, that shows the possibilities if you actually have a prime core asset in the portfolio. So essentially, that is one strategy we have. I'll touch on the other strategy, which we call a barbell strategy, a little bit later on. But now moving on to the key highlights for the third quarter. So we saw revenue come in still strong, and also NPI still strong. NPI was down a little bit more than revenue because there was a upward revision of property tax for our 2 hotels, but from IRAS. Otherwise, it would have only been down circa just a little bit over 1%. Now, operationally, the portfolio performed well, but revenue came down a little bit because of the normalization of travel and normalization of the Chinese when they actually came back in Singapore. It was July 2023, August 2023. That's when the room rates went up really high, occupancy pushed really high. That was the revenge travel from the Chinese as they came out. So that moderated in the third quarter of this year. Hence, you see revenue coming off a little bit, NPI also down a little bit as well. But overall, if you look at our portfolio, Singapore office occupancy remained high at 95%. That is higher than market, which is circa 92%. And we achieved positive rental reversion of nearly 11% for the quarter. Now, again, coming back to the Gamma strategy, the prime quality of our asset has meant we have seen 8 quarters, 8 quarters of positive rent reversions. It was this year, it's ranged between 11 to 13% per quarter. So again, very strong rental reversions coming through. Now, hospitality segment, as I've touched on earlier, has moved up quite significantly. When we come to the slides later, it's very clearly reflected how well we've done post-COVID, and we can compare to what the numbers were in 2019. Mandarin Gallery, again, positive rental reversion for this quarter. The past 4 quarters averaged circa 30% per quarter in terms of rent reversion. So very strong. Retailer sentiment has been coming back over the last 4 quarters. So overall, operationally, really strong quarter for us again. I'll hand it over to Lionel for the financial slide.
Thank you, Han. Okay. So for the third quarter, revenue came in at 75 million, which was about 1% lower compared to last year. This was mainly due to the lower contribution from the hospitality segment, as Han shared earlier. For NPI, it came in at 60 million, 3.7% down versus last year, due to the clawback of the prior year's property tax for the 2 hotels. So if you exclude the property tax adjustment, the NPI would have decreased by a similar 1% compared to last year. So moving on from 4Q, we'll be taking our management fees 50% in the form of cash and 50% in units. So this is a change from the first 9 months, whereby we took our base fees all in cash. So this switching of management fees will have a positive impact to the distributable income. It will add on another 2 million, and it will contribute to the increase in the DPU. In terms of NAV, NAV remains stable at 59 cents as of 30th September. Okay. So moving on to the capital management, following our very successful 250 million investment grade issuance in June, we had a reverse inquiry that came in September for a 7-year investment grade green notes. So we were able to move very quickly and got ourselves launch ready in about 4 days' time. So immediately after the FOMC meeting, we were the first to charge out of the gates, and we went out with a IPG of 4.15%. So we actually secured a peak order book of 320 million, which was 3.2 times oversubscription versus our initial target size of 100 million. So we ride on the momentum, and we were able to upsize the offer to 180 million, and at the same time tighten the pricing by 25 basis points to 3.9%. So this 3.9% is by far, so this bond issuance is by far our longest dated issuance, and it came in at the lowest coupon that we have ever achieved. So based on this 3.9%, we believe that it's very competitive compared to what Gerald shared earlier, where the US 10-year treasuries are trading at, which is at 4.2%. So with this very overwhelming demand, we tightened the pricing, and even though we tightened the pricing by 25 basis points, the order book remained very sticky. There was only a drop of about 20 million, so we still had 300 million order book, and this equates to about 1.7 times oversubscription versus our final upsized order. We're very pleased because like our previous issuance, 70% of it went towards the institutional investors. So it was very, very well supported by the institutional investors who are very discerning about OUE REIT's credit. They were not dependent on the private banks, who are typically more sticky in terms of the yield requirements. In just about 2 weeks back, we also announced setting up a EMTN program to allow us to diversify our sources of funding. So the reason why we wanted to set up this EMTN is really to allow us to tap into the US dollar bond market. So the US dollar bond market is typically has more liquidity. Each time you tap the bond market, you can raise US dollar 300 million. So it will help us to diversify our sources of funding. And the US dollar market, typically you can tap on the longer end of the issuance, 7 years, 10 years. So that will really help us to spread out our debt maturity, whereby each year we do not have a very big chunk of loans that we need to refinance, and it will really manage our refinancing going forward. So with this 180 million green notes that we issued in September, the average term of debt has now lengthened to close to 3 years. And our aggregate leverage is now stable, remains stable at 39.3%. So some sensitivity, so we assume a 25 basis points cut in interest rates that will have a positive impact on the DPU of 0.03 cents. If you notice, from June to September, the percentage of fixed rate debt has also increased from 61% to 70.5%. So what we have done during the quarter is when we saw that the market was running ahead, there was a lot of expectation in terms of the number of rate cuts, how deep the rate cut is going to be, 250 basis points cut, six cuts in 2024 alone. So we felt that market was running ahead of themselves. Inflation will remain sticky, interest rates will not decline as fast. So we went in, we locked in a couple of long-term swaps, and since then, market has expectation of rate cuts have gone the other way, as what Gerald shared in his presentation earlier. So we believe that we have actually locked in a couple of good trades, and that has brought our fixed rate debt up to 70%. And with that, our weighted average cost of debt has crept up slightly to 4.8%. We believe this is probably the peak interest rate for us right now. We should expect to see the average cost of debt moving in the right direction, i.e. trending downwards, if not in the fourth quarter, but definitely moving forward into 2025. Moving on to the debt maturity profile, you can see that with the refinancing that we have done, the 2 bond issuance, we only have about 6.7% of debt that's maturing in 2025. So it's about 160 million. So we are sitting in a very comfortable position. The intention is to refinance that. And because we have a huge chunk maturing in 2026, we also have headroom to actually look at early refinancing some of those debts and probably push that, do a 5-year and land it in 2030, where there's no debt that's maturing, and then achieve a very well-balanced debt maturity of about 400 million each year. Okay. Thanks.
Thank you, Lionel. So moving on, we're focusing on the asset management part of our portfolio. So if you look at asset value by property, it's very well diversified. Again, revenue by property, very well diversified. Now, one number I want to point out to you is the Lipo Plaza. That represents 6.6% of our total portfolio. Now, I'll touch on why a little bit later, but I just wanted to flag out that number. Now, I talked earlier about our gamma strategy and had referenced lightly to our barbell strategy. So we believe having a barbell strategy, which you see on the most right pie chart, where office represents about half of our income and hospitality and retail contribute to the other half. So one side of the barbell, office, they have 3-year leases and very stable income coming through. Hospitality and retail, we see with improved visitor arrivals coming through this year, forecast by STB, it should be 15 to 16 million arrivals. Back in 2019, it was 90 million arrivals. So we're on track this year as an improvement from last year's 13 million visitor arrivals. And we think next year will continue to grow. So we see upside coming through from the hospitality and retail sectors in terms of income growth. Okay. Again, very well diversified tenant mix. Obviously, some of you will read in the papers that there's stress in the tech sector, in various sectors, but most of our floor plates in our offices are 20,000 square feet and below. And most of our tenants range between the 1 to 5,000 square feet. So very well diversified tenant mix. So if the tenant was from a manufacturing distribution and that sector happened to be down, that is fine. That can be taken up by energy and commodities sector, which will easily take over that space, because again, that space is a very generic space in terms of the size that most of our tenants are in that 1 to 5,000 square feet. So easily replaceable. If you look at our in terms of lease expiries, we've renewed most of our leases already. Those that are there, I would say 90% of them are non-renewals, and that's nothing to be alarmed about. Every year we budget in a certain proportion of our tenants will not renew for various reasons. Now, we've already started with our lease renewals, discussing lease renewals for the year 2025 already. Okay. Now, moving on to the commercial segment. We saw income dip somewhat. That primarily was due to a decline in contribution from our Shanghai asset, the Lippo Plaza. But overall, we managed to maintain NPI at a fairly stable level. How do we do that? We entered into much more sort of cost-effective utility contracts, which locks in at much lower rates. We try to utilize more automation in our management of assets. So various things that we try and do in order to maintain our cost levels to be a lot tighter. I talked about the average expiry, lease expiry. So most of this year is done, as you can see in 2025. Certain 3+% of that by NLA and by gross revenue income. That has already been renewed, and we're working through the other tenants. So overall, Singapore office portfolio performance has been very strong, as I discussed in the first slide. Our average passing rent has continued to tick up. Now, if you look at the bottom left chart, that is quite instructive, because if you look at 2025 and where spot rents are currently at 11.95, say if spot rents in the office market were to decline by 5%, that takes us down to roughly $11.30 per square foot per meter. Now, for lease renewals in 2025, it's 10.42. So there's still a comfortable buffer for us to negotiate with our tenants and to push positive rent reversions again for the next couple of quarters is how we feel. Gerald touched on supply and less supply going forwards from 2025 and a bulk of supply this year. So the bulk of supply is the completion of IOI Boulevard. Now, that is that building is circa 1 million square feet. My understanding is it's been 70% pre-committed, meaning it's been leased up. So there's a balance of 40%. The owners are hopeful of bringing that level up to 80%, which means they will not be, once they hit that level, they will not be slashing rents and applying and pushing rents down. So we don't see a lot of pressure coming through once they are up at that 80% level. Now, the other thing is, so for incumbent tenants, for incumbent landlords, so landlords like us, which have a high committed occupancy of 95%, there's a distinct advantage as opposed to owner of a building which comes in and tries to fill the building up. Because currently, the context is tenants are very reluctant to spend capital expenditure to do new fit outs of their offices, because it's a large capital expenditure in an environment which is still, interest rates are still quite high, and there's geopolitical tensions, there's the US election just around the corner. So a lot of uncertainty, and a lot of companies would rather just renew and stay in their current premises. So for us and other landlords which have high occupancy, a distinct advantage there. So and we try and capitalize on that as well. Okay. Shanghai Lippo Plaza, I mentioned earlier that 6.6% number in terms of total revenue contribution. Look, there's a lot of oversupply in the Shanghai office market. And on top of that, the business sentiment is still quite weak despite the stimulus, the talk of stimulus coming through. The budget has to be passed by the Parliament, by the People's Congress, and that's not for another couple more weeks. So until that number comes, and until all those funds flow through and pass through the economy, and the wheels start turning again actively, business sentiment will remain very, very cautious. So until business sentiment improves strongly, will we start to see rents move up and also office occupancy keep ticking up. On the flip side, because of the prime core nature of our asset in Shanghai, we're 2 minutes walk from Sivanithy, for those of you who are familiar with Shanghai, and we are directly opposite the Hermes flagship store in Shanghai as well. So that shows how prime the location is. So because of that, we've seen actually occupancy continue to hold strong at that 95% level over the past couple of quarters. And this quarter, we've seen actually a pickup because, again, we're able to backfill some space which was empty. Again, so we feel having this prime core quality in our portfolio will help us ride through the tough times, or the times when there's a lot of volatility. Okay. So Mandarin Gallery, occupancy remains strong at that 95% level. Now we see rents having bottomed out already, I would say, and start to pick up. We're still not at the pre-COVID level, I would say. We see tenant footfall back to pre-COVID numbers already. However, the spending and the tenant sales, our tenant sales, are circa 85% of pre-COVID levels. Now, a lot of the tourists, especially the Chinese tourists that have come through, they've changed behavior in terms of their spending patterns. They are less on luxury, less on conspicuous consumption, and a lot of them are now focused on health and wellness, which does benefit us as well, because the Mandarin Gallery, especially on the higher floors, we have a lot of health and wellness offerings, even from pre-COVID times. Now we're looking at ways to enhance that to attract the right shoppers to come through Mandarin Gallery, and we continually tweak that tenant mix for Mandarin Gallery, but it's something to watch out for. Now, the other larger retail asset we have is the One Raffles Place retail mall. So that's circa 100,000 square feet. Occupancy there it's very high. It's nearly fully, it's sort of nearly full, high 90s. But what we've seen there is in July and August this year, tenant footfall is at a million people. So the last time we saw that was in 2019, where it was only 1 month. It was the month of July 2019. So in terms of footfall, we're completely back to pre-COVID level. In terms of tenant sales, we're actually sort of 5-6% above the pre-COVID levels already. So it means people are fully back at work. Rest assured, yes, there is some hybrid working, but people are fully back at work and they're spending. So that bodes well for the office sector and also for our 3 Singapore office assets. Okay. Now, the hospitality segment has been quite interesting for us for the last couple of quarters because of the revenge travel, 2022, 2023. Now, I would say this year, there's a lot more moderation, despite visitor arrivals still improving. So if we look at revenue was essentially flat, down a little bit. And actually, MPI also has come down. MPI has come down because of property tax, land rent at the Crown Plaza. So that has increased a little bit. But revenue was very high in the third quarter of 2023, again, due to the revenge travel from the Chinese. Now, we don't expect that to be a permanent feature, but there is more normalization of that. Now, the Chinese currently represent, I would say, circa 22 to 25% of total visitor arrivals into Singapore over the past several months. And they will continue to be strong. And we see, obviously, the Chinese, they're spending down, they're sort of buying down a little bit because they're a little bit more price sensitive these days, especially as the economy is doing well, and that's to be expected. But nonetheless, they remain a strong contributor to our two hotels, especially the Hilton. Less so the Crowne Plaza, where the levels have stayed pretty much the same. Now, we talked about, obviously, we talked about the Hilton and the RevPAR numbers. So yes, the performance of the Hilton came down from 345 to 315. But again, if we look back at the last 2 quarters, $315 is the highest quarter for this year. And if you compare it to the pre-COVID levels of 2019, look, it is $100 above RevPAR. So I think it's, we do hope, we do hope to push the numbers through, and the management at OUE REIT continues to push that number with our general managers in the 2 hotels. However, I think we also have to constantly remind ourselves to be somewhat more moderate in terms of expectations going forwards, because that revenge travel has sort of burnt itself off already, and we have significantly reset to a much higher level in terms of RevPAR for the Hilton. Now, the Crowne Plaza Changi Airport, we completed our asset enhancement initiative in December last year, where we added on 12 more rooms by the pool. We moved our all-day dining to the ground floor, where as you walk in from the arrival hall at Terminal 3, you exit customs, you turn to the left. It's 150 meters, and you're inside the Crowne Plaza Changi Airport. It's very, very convenient. So again, RevPARs were 196 pre-COVID. It is 259 in 3rd quarter of this year. And our asset enhancement has, the offering has been very well received, and we've seen also a nice bump up. So again, pre-COVID levels, overall hospitality segment, we saw RevPARs at 209 on a blended basis. And again, on a blended basis, it is 296. So a significant step up as combined portfolio. So this, the hotel industry and the hotel segment, we believe will continue to do well because ASEAN is 650 million people. India and China are 1 billion each. So, and income levels continue to rise. And as income levels continue to rise, travel will be a big feature in their consumption pattern. So we want to be positioned properly to capture the macro trends over the shorter, medium, and the longer term trends in the hospitality segment. So what we really want to do is, earlier, if you recall the earlier slides, our current hospitality income is circa 34% of our total portfolio. We do want to move it to 40% going forwards through some acquisitions, but also through the growth of our 2 hotels. So next year, I mean, what do we have to focus on next year? Next year, Universal Studios are bringing in Super Nintendo World. They have Minion Land, and at the end of next year, Disney Cruise is making Singapore a permanent port. So that will again bring more tourists into Singapore. Okay. Now, in terms of hospitality segment mix, that's sort of 22 to 25% geo-source visitors into our hotels, into Singapore. Now in our hotel portfolio, we see for North Asia that 31%. It used to be 20% in 2019, and that number is now circa 20%, and it continues to rise. And that is represented by the Chinese, and the balance we've seen the Japanese come back, and they're circa 4% now. The Japanese have only started coming back, I would say, the last probably 2 quarters. So that's improved nicely. With the rebranding of the Hilton from the old Mandarin, we're seeing strong corporate travelers coming in from North America, especially, and also Europe. Now, a little bit different from the 2019 for the pie chart on the right, transient. Now, what is transient? Transient is bookings, online travel agent bookings, Booking.com, etc. So these are the higher yielding booking types. So the ones where we generate the highest room rates. So wholesale is obviously the lowest yielding. Corporate is a little bit higher than wholesale typically. So transient is now 67%. Pre-COVID, it was 51%. That's how we're able to drive our ADRs and also our RevPARs higher for both the Hilton and also the Changi Airport. So we continue to be positive with regards to our hospitality segment. Probably growth going forwards will not see that huge run up and that huge spike, but more really sort of a more normalized growth, or probably 2 to 7%, depending on where inflation is and where the GDP growth of the country or of the region will be. So market outlook. What do we see? Office, I believe office rents will stay fairly sticky. Occupancy, yes, it has dipped down to 92%, but as Gerald has shown in the earlier slide, there's very little supply going forwards for the next couple of years in the office segment. So that should allow us to have occupancy start moving up and rents staying fairly sticky. Retail rents, we've seen it start moving up, but again, it really is positioning correctly to capture the new spending patterns and the new consumption behavior of the visitors, especially the Chinese. Hospitality, I mentioned earlier, visit arrivals. We're likely to hit that 15 to 16 million number in 2024. And there are a lot of events planned over the next couple of years. A lot of new additional tourist destinations being built in Singapore. So Changi Airport's also sort of building the Terminal 5 in anticipation of the growth of passenger arrivals and then sort of passengers coming through Singapore. So over the sort of medium term, that's also looking quite healthy and positive. Now, the one area which for us is a concern, which we look at very closely, is our Shanghai office and retail mixed-use development. Again, that represents 6.6% of our total income for the portfolio. So even if overall tomorrow income was to drop 20%, that 6.6% represents circa sort of 1.3% of our total portfolio. So yes, it's not ideal, but it is not a significant impact on the portfolio as it is. Now, lastly, on what are we doing as the manager of the REIT, and where do we hope to take the REIT to? So 3 key pillars. The first pillar is maximizing asset performance. So tenant retention is important. So we engage with our tenants earlier. We ask them earlier, are they likely to renew? What are their needs, etc., and try and match them. Some of them want to grow. Some of them want to consolidate. Some of them need to have lower rent. So we'll find alternatives for them. Do they take a smaller space such that overall payments in rents remain the same quantum, but they're able to still stay in that building? Maybe sort of reconfiguring their layout in terms of seating, etc. Leveraging asset enhancement initiatives. So we've completed 2 asset enhancement initiatives for the 2 hotels, and we've seen obviously the RevPARs pick up for both hotels post asset enhancement. We keep up with all our green and environment credentials for all our assets. In Singapore, it is a green mark. In Shanghai, we have just received the LEED Platinum status for that asset. So it's important for us to keep up with the green marks and the LEEDs certifications, because tenants are increasingly looking at this, especially multinational tenants. So it's either you have it, we'll consider your building. You don't have it, and we'll just exclude it. So that's very important for us as well. Again, we'll explore what else we can do in terms of asset enhancements for our other assets going forwards. Lionel has touched a lot on the active cost of debt. Now, I can't emphasize enough, the cost of debt is one of the key ingredients in DPU performance of a REIT. So going forwards with interest rates coming off, we do believe we'll see some further upside in DPU from the decline of the cost of debt. So lastly, we're looking at how else can we create value in our portfolio. So one is increase hospitality segment contribution to 40%. It will come through from the growth of our 2 hotels. We also have a right of first refusal on our sponsor's assets. So our sponsor has recently been awarded a 250-room key Indigo Hotel in Terminal 2. So it will sit right on top of the Terminal 2 coach bay. For those of you, it's right next to the car park at Terminal 2, basically. So that will be completed in 2028. So we have some time to evaluate it, and if it's yield accretive, it makes sense. Then yes, we'll look at that very closely. We also look at we're looking at cities like Sydney, Melbourne, Tokyo, London, Hong Kong, where there's been a lot of repricing for their office assets and also for their hospitality assets, which very different from Singapore, where yields are very tight, capital values remain still very strong. So we're looking at that. But how would we acquire these assets, you might ask? Look, we understand where our price book is currently trading. We're trading quite far below parity. So doing an equity fundraise really does make sense. So it does mean we should sell 1 or 2 assets which are lower yielding, which may need further capex in terms of bringing it up to speed again, or additional chillers, etc. Down the line. Then we may look at exiting some of those and recycling capital into newer assets with better green certification that provides higher yield. So that's how we're thinking about it. Okay, that covers our presentation. Happy to take questions.
Okay, thank you very much, Mr. Han, and thank you, Lionel, as well, for your presentation. Just my own interest, I remember in July, MAS proposed raising the gearing ratio to 50% and the interest coverage ratio to 1.5 to basically to streamline all the requirements. Has that come into force yet, or is it still a proposal?
Oh, that's still a proposal. There was a consultation paper that was circulated. So
okay, so they haven't.
So that's something which, but you see, the reality is, I think a lot of the investors in Singapore REITs are very well trained, I would say, or well accustomed to the fact that once gearing level goes to 43, 44%, they expect an equity fundraise, and then the share price, the unit price, actually correct itself to account for that equity fundraise. So I'm not quite sure whether raising that 50% will really mean that REITs will push it past that, too much past the 40% level, really, because it does cap itself in terms of unit price adjustments.
Okay, all right. Okay, thank you again. Now we'll move on to the Q&A session. Okay, the first question is from Kotek Kwan. I have been holding OUE REIT since its IPO. And why has the share price not recovered back to its heydays? I think the IPO price, if I remember right, was 80 cents. So any reply? Would you like to take this question?
So I think if you look back historically when it was listed, it was just 2 assets. Okay, it was the OUE Bayfront and Lippo Plaza Shanghai. So asset value, so AUM was circa $1.7 billion. Now, back in 2014, this was an acceptable size, I would say. But very quickly, there's a recognition throughout the industry. Actually, you needed to ramp up scale very quickly. Otherwise, small REITs risk becoming irrelevant because the liquidity is not there, and means institutions are not there, which means the REIT can't grow. So there were 2 sort of corporate events that occurred, one in 2015, the other one in 2018. So 2015 was the addition of the One Raffles Place. AUM grew to 3.5 billion from 1.7 billion, so it effectively doubled. Now, there was some, I would say, some dilutive equity fundraise done there, hence the value actually, the net asset value came down. And then in 2018, there was the acquisition of the OUE downtown office. So that then grew to 4.5, circa 4.5 billion, 4.6 billion AUM. Now, again, throughout that period, there really was a need to grow. So it was either you grew or you faded into into irrelevance with regards to institution, so fundraising, debt, etc., even dealing with banks. For banks, now to do a $500 million refinancing, it's nearly the same effort as doing a $100 million refinancing. So they would rather work on a $500 million and as opposed to a $100 million refinancing, because they knew if you were a larger REIT, you would be back in the market to do refinancing, other sort of capital market actions. So banks are likely to support that type of REIT more, as opposed to if you come once every 3 years, then it's less interesting for banks and less interesting for fixed income bond holders, etc. So you needed to grow. Okay. So again, somewhat dilutive equity fundraise, unfortunately, was done back in 2018. So then that brought down the net asset value. Okay. But back then in 2019, there was the merger of the two, the hospitality REIT, which then added on the Crown Plaza, back then the Mandarin Orchard Singapore, and now the Hilton, and also the Mandarin Gallery to the portfolio. Then that grew to circa over $7 billion. Then we sold down 50% of OUE Bayfront to Allianz, and now PIMCO. And they sort of rebranded as PIMCO Real Estate now. So that allowed us to pare down debt, bring debt levels down, and be at a certain scale. Now, throughout that period, I mean, currently our NAV is circa sort of 58 cents or so. Okay, so 58 cents to that, so 80 plus cents is very far off, and we're trading at price book circa sort of 0.5, 5.6. Okay, so post merger, we ran right into COVID, so where hospitality assets were sold down, obviously because no one could travel and you couldn't fill up the rooms. Office also took a hit during that period, and coming out of COVID, there was a whole hybrid working and a lot of negativity with regards to the office sector. Now, a lot of that also took place in the US, and we still see the US is still suffering from that. But Singapore, fortunately, the government's has had a lot of foresight, and they try and sort of reduce that volatility in rents and occupancy and vacancies in the office sector by managing the supply. So we've been able to maintain capital values, strong capital values, and we've been able to keep our yield and cap rates at a very sort of I would say very aggressive levels at sort of circa 4% for office sector. Whereas as compared to, I mean, Australia, if you were to go to Australia, a prime office asset, not brand new, you probably pick it up at 6%. But in Singapore, that is trading at a 4% cap rate. Okay, so again, there have been a lot of headwinds post-merger. The post-merger was supposed to bring us back up to sort of price book parity levels. Unfortunately, a lot of headwinds going through there. But I think, and then we had obviously the interest rates pushing up, which again meant REITs were sold off because it was, REITs were going into a period of strong headwinds. Now that hopefully it's behind us, and Lionel's mentioned, we do think peak rates for us is where we are currently at 4.8%. Probably this quarter, maybe next quarter, but in 2025, we'll see that the cost of debt coming down in 2025 with regards to how we structured and positioned ourselves over the last 2 years in a very active manner. So I do see, hopefully we'll close the price book and we should start having our unit price moving up in tandem.
Okay. Thank you very much, Mr. Han, for that answer. There's another question here, but I think you've already answered it in the presentation from Tan Chun Lai. What is the average cost of debt for the REIT? I believe it's 4.8%.
That's correct, yeah.
Yeah, so okay, that one has already been answered. Another one also you have partly touched on. OU from Lai Yong Chang. OUE REIT's portfolio is still mainly Singapore properties, -1 in China. Any plans to diversify your business further into other regions? If yes, any particular country are you looking at and why?
Yeah, we're looking at Tokyo for hospitality. Tokyo because again tourism is a key driver into Tokyo. And obviously, I mean, if you ask your friends and you ask people around you over the last 12 months, most of them will have been through Tokyo or Osaka or Japan, right? So so Japan tourism will continue to be strong, and we do think that's a good place to be in. But however, there's a lot of money chasing Tokyo hotels. So we remain cautious and we'll continue to monitor the market there. We do like office in Sydney, prime grade A office in Sydney, and also hospitality hotels in Sydney, because it's fairly landlocked, ocean or the sea on one side, and highlands, a mountain on the back of that. So fairly landlocked, not a lot of supply. We do think because the Central Bank of Australia still haven't cut rates, and we don't see them cutting rates until probably second quarter of next year. There's a lot of stress in that market. So we think there are interesting opportunities. We took a look back in 2022, third quarter, fourth quarter 22, and cap rates for prime grade A office buildings were 4.5, and all. Everyone was telling us, look, you can't go more than 4.5, 4.75. Look, today, if you walk in and you tell them, look, we're happy to buy a prime grade A office, again, not a brand new one, but maybe something that's been built for 10 years, you could pick it up at 6% cap rates. We've seen some of our peers in Singapore do that recently. So we'll monitor that, but we're not jumping in as yet because we do want to pick the right asset class, and we'll probably want to recycle capital as well at the same time.
Okay. Okay, we're running short on time. I think there's one more question here from Mr. Lai Yong Chang. Hospitality side seems to be doing better. Basically, that's what he's saying. Any chance of bumping it up to bumping up more on the hospitality side so that we unit holders can enjoy better DPU?
What we're really hoping for is sort of 50% from office and probably 40% from our hospitality and 10% from the retail sector. Because we want to provide stability, we want to have some stability and some growth, right? So it's a bit like the question is, it's a bit like Lionel and myself, we talk about it. It's a little bit like do you want to stack your whole portfolio with Tesla shares and Nvidia, or do you want some utilities, do you want some fixed income, do you want some fixed deposits plus a little bit of Nvidia and a little bit of Tesla? So yes, we do want some growth, but I'm not sure our heart can take a sort of 30-40% move every quarter in terms of DPU growth or decline. And I don't think our unit holders would appreciate that too much either.
Okay. Yeah. All right then. We've reached, well, it's just about time now. I think I'll wrap it up for the night. Thank you so much, Mr. Han and Lionel, for your presentation. I hope it's been informative and useful for the audience. If you have any questions, you can connect directly with the company. In case you missed any part of today's session, you can rewatch this webinar on SIAS's Facebook and YouTube channel. Now, Corporate Connect is a bi-weekly webinar, so please visit SIAS's website for the latest upcoming investor education programs and other initiatives. So the next Corporate Connect event will be on the 5th of November, and that will feature another REIT first week, right? So you can also type into the chat box now if you with names or suggested names of companies that you would like us to feature. And that's about it for this evening. Thank you again to OUE REIT for a very illustrative and instructive presentation. Thank you to everyone here who has joined us, and take care and have a good night. Thank you.
Thank you, Siva.
Thank you,
everyone. Good night.